I mean, gold is interesting. We've been bullish of gold for a few months now, and I mean, it's kind of been stuck in the 1950 area for a while. But it's if you think about it, the U.S. dollar index DXY is up sharply over the last 2-3 months, but gold prices aren't really down. They've just been kind of flat and actually inching higher. I mean, today we're back above 1950. It's almost like you have high rates, you have higher dollar, but then you have flat gold. That, in my opinion, is pretty strong price action. I mean, in an environment like this, especially with the Fed keeping the Fed funds rate above 5% for a prolonged period of time going forward, I think gold has actually been pretty resilient.
Welcome back to Soar Financially, everybody. Thank you so much here for joining us. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. And this is a discussion I've been looking forward to a while. When my colleague actually entered the meeting or the interview in my calendar, I got a little nervous because it's with Adam Kobeissi. He's the founder, editor-in-chief over at the Kobeissi Letter, a quite influential and powerful name out there in the Twitter space, something or a subscription to publication I follow on X now quite a bit as well. Really good commentary, not just the typical aggressive one-liners from some of the commentators out there, but some good context, some good charts, and yeah, lots big following, which makes me a bit nervous because that's going to put me on the spot. But I'll try to move the limelight and the spotlight onto Adam here in a second and put him in the hot seat.
Thanks for having me, Kai. Excited
Yeah.
to be on.
Hold on. You're not on yet, but it is great to have you. Because I was gonna say one more thing, Adam, is subscribe to the channel before I switch over to my guest. That way, we can bring guests like Adam on more regularly. Fantastic, Adam. No, as I said, like huge honor to have you on the program. It's great to see you, and let's dive right in. Let's set the scene a little bit, and also maybe the tone of this conversation by asking you, like, how do you rate the current state of the economy?
Yeah, so thanks for having me on. I love what you guys are doing here, and I think it's great to bring a diverse background and just viewpoint to the channel. And I mean, our view, the economy has been evolving so rapidly over the last couple of years, especially with what's happened with the Fed, with inflation, with commodities, with liquidity, with real estate. Every part of the market is kind of in a different realm. But I do think that markets have been far more resilient than people have expected. I think they will continue to be far more resilient than people have expected. And I think if we do see a recession, it's going to be much more mild than what was previously anticipated by everyone, basically, including the Fed. And the labor market is pretty strong. Inflation has been kind of stubborn in the 3 to 4% range, and it might get a little bit worse now with commodities back on the rise. But generally speaking, I mean, we've been bullish of equities for the majority of this year just because of the fact that this is probably one of the most resilient markets we've ever seen. And I think there are parts of the market that are showing a lot of weakness. I mean, you and I briefly just talked about commercial real estate off the camera, but that commercial real estate is in severe bear market territory. But then you have housing prices, which are on the exact opposite end of the spectrum, and then you have equities somewhere in the middle. So there's a lot going on. I think there's a lot of opportunity in the current backdrop, and I do really think that equities in particular have just been incredibly resilient, and that will remain the case.
Interesting. I sense a bit of optimism in there because I mentioned to you as well before hitting the record button. I've been always looking for the doom and gloom scenarios in conversations based on what you just said. Like everybody's been expecting a recession not coming. So I think it's time to change viewpoints a little bit and ask questions of where are things headed, up or down. And usually we didn't look at the upward scenario, especially on the equity side.
Yeah, and I think it's important to note that the stock market is not the economy. So you can be bearish of various parts of the economy or various macro trends that you think are concerning, but stocks can still go up, right? So it's important to keep a disconnect between the two in some way. Obviously, they are correlated a little bit, but just because we are seeing parts of the economy in weakness doesn't mean stocks are going to crash, and not every crash is 2008, right? So I think there's a lot of just, we're coming off of 2008. It's the last major recession other than the pandemic induced one for a couple quarters. It's not a 2008 scenario now. So calling for 2008 is not necessarily a smart view in our opinion.
Yeah, I definitely come from the gold or commodity space as well. So always look for the doom and gloom scenarios or any scenario that benefits the gold price, pretty much, right?
Yep.
So
Yep.
that's maybe a bit of a conundrum I'm caught in
Yeah,
personally
yeah.
as well, right?
I mean, gold is interesting. We've been bullish of gold for a few months now, and I mean, it's kind of been stuck in the 1950 area for a while. But it's if you think about it, the U.S. dollar index DXY is up sharply over the last 2-3 months, but gold prices aren't really down. They've just been kind of flat and actually inching higher. I mean, today we're back above 1950. It's almost like you have high rates, you have higher dollar, but then you have flat gold. That, in my opinion, is pretty strong price action. I mean, in an environment like this, especially with the Fed keeping the Fed funds rate above 5% for a prolonged period of time going forward, um, I think gold has actually been pretty resilient. So you might be onto something there with the gold trade.
No, no, absolutely. It has been extremely resilient based on like what you said, like the US dollar at 105, the Dixie here as well. So big competition, right? Especially,
Yep.
and you mentioned the interest rate environment because usually interest rates go up, gold goes down because it's easier to get a nice coupon, right?
Yeah,
and
yeah, exactly.
and gold
Yeah,
doesn't yield.
yeah, and the rate situation is also, I mean, we can get into that if you'd like, but there's so many factors moving rates higher. You see, I mean, that's why mortgages are nearing 8%. There's a lot going on here. So, um,
Absolutely, and we're just jumping
yeah.
around a little bit, but I want to get back to something you've said just in your opening remarks. Here is the resiliency, because I'm trying to figure out where it comes from. Everybody's been, sort of forecasting even, a break in the job market, higher unemployment numbers, but we're not seeing it. The question is now, is it just a statistical, how do you call it, like variance, right?
Right.
Or is it really that strong? And the question is like, why is it so strong?
I think it's really interesting because even though we've had a bear market and the lockdown, like we've had an unprecedented amount of volatility since 2020, but I feel like coming off of this historic bull run, I mean, basically a 10-year bull run where the S&P, I mean, for years, the S&P was making new high all-time highs every single day. If you go back to 2018, 2019, 2017, like every headline coming out of CNBC and all the major media outlets was S&P closed at a new all-time high. And I think what that did was it induced a lot of FOMO type price action where once we finally did see volatility for the first time in years, now everyone's saying, all right, is this really a crash, or is the dip going to be bought, and should I get in now? And people at the same time, that's coming with people moving deposits out of banks. They're searching for yield. You have money market funds paying 5%. You have a lot of capital that's actually on the sidelines, surprisingly. Um, and I think you combine those two factors, that's why the market just continues to be bought. I mean, we've had every reason to crash. We've been saying that the low was in last year in October. We still think the low is in. And I think these two factors are just very hard to fight unless something really changes fundamentally speaking.
And that's the question, right? So now I promised myself not to ask the straw that breaks the camel back, the straw that breaks the camel's back question, but like, what are some of the indicators you're looking for here as well? Like, what are you focused on?
Yeah, I think it really depends on what you're investing slash trading in. But I think one thing we've really been watching is housing, just to kind of determine the state of the consumer, where housing is like it's a very interesting situation right now because the housing market, if you just look at the charts, if you look at price, if you look at all the data, you would say that the housing market is in a major bull market. We're not on the brink of anything. Delinquency rates are below 3%. Everyone's, this is a great situation at the surface level. But I think if something does happen that does make the housing market start to turn lower, that could be something that spreads further into equities, into the record levels of credit card debt we have now. Just seeing general weakness in consumer spending, you could see retail start to take a hit. You could see tech take a hit. So I think that is one part of the market that we're watching closely. And the housing market is entirely a supply situation. Demand and second property, vacation properties, for example, a second home is down 50% over the last year. You have investors are now pulling out of the market pretty rapidly. They're accounting for less than 20% of purchases now in the housing market. And you have but yeah, you have historically low supply because 90% of borrowers are locked into mortgages in the 3, 4, 5% range, right? So you need, what we're watching is what will make supply come back to the housing market. And if that factor becomes likely, if something is going to bring supply back to the housing market, that could easily trickle into many other parts of this market, especially as we now expect a very long Fed pause, meaning rates aren't really going to come down anytime soon. And supply is unlikely to return from lower rates. So I know that was a lot that I just said, but that's
No,
really the part that we're focusing on a lot right now.
no, that's interesting because I think real estate is probably key here as well. Because A, there's so much money tied up, and B, it's directly impacted by the Fed policies. Like that's something you're
Absolutely. Yeah,
seeing
yeah. Yep.
immediately impact. You mentioned 8% mortgage rate, and I remember I've been bringing that up in other discussions as well. But I watched a lot of like let's call them FinTubers on YouTube and Twitter, and a lot of them bought like marginal real estate as passive income investments, right? And to now with 7-8% mortgage rates, those passive income investments, they will hit the market at some point. So supply is going
Absolutely.
to
Yeah. I
hit the
mean,
market.
and buying as an investor right now, especially in well, in either commercial or in residential, the cap rates have come down so sharply that it's almost like what you have: high prices, high rates, and in many markets you're actually starting to see a rent demand starting to decrease a little bit. Even though rent prices are up, demand is coming down. It's a bad time to be a real estate investor right now, especially if you're in commercial real estate side of things. So it's interesting. It's a great time to be a real estate investor that bought in 2020 or 2021, but it's a bad time to be a new investor, just to make that clear.
Yeah, I've been having that discussions with friends of mine as well, just personal discussions. 39 years old, looking for their first home to buy. Right, Germans usually rent first before they buy, and they're looking. They missed an opportunity like 5-6 years ago, I
Mm.
think. So, and now they're waiting for rates to come down. Although Germany is still much lower, I refinanced earlier this year, fortunately for 0.9. Right, so
Yeah.
that's
So yeah, I think we're seeing the same kind of trends everywhere. I think there's more people renting now, just like you're saying, more people renting than ever. But the crazy part is renting isn't really even that much cheaper. I mean, median rent in the US is nearing 2,000 a month. And it's never happened before. Um, I know it's probably about 30% cheaper to rent than buy as far as your monthly payment, but you're also not building equity, and you're not a homeowner, right? So home ownership rates are certainly going to decline in our view over the next few years.
absolutely, yeah. No, where else is it supposed to go? 8% mortgage rate. That's insane. Like, it's
Right.
just like at least that's insane to me because I'm not used to that. Like personally, I've never seen that. Right.
Yeah, and that's a great, that's a great point. That's something that we've been commenting a lot. Um, so 8% mortgage rates, if you look back in history, it's really not that high, right? I mean, in the 80s and the 90s, they were well above 10%. So people were getting 9% in the early 90s and saying, wow, what a deal, right? So I think what's interesting is most most people have not experienced inflation or interest rates at the current levels that they were at or where they were, especially in 2022 in their adult lives. That's why it's come as such a shock. We're coming off years of low interest rate policy. I mean, even in 2008, mortgage rates peaked at 6.6%. Like it's there's kind of a shock effect happening. And that's seen all the way around the board. Even the interest paid on US debt. We were talking about the debt just hit 33 trillion in the US. A lot of that debt is now being either has to be refinanced or new issuances are being issued at much higher rates. So that means interest on that debt is more expensive. The same thing is being seen in commercial real estate. There's 1.5 trillion of loans coming due by 2025 that all have to be refinanced at much higher rates. Mortgages, if you want a new mortgage, the rate has now tripled. And even though they're not historically high rates, they're much higher than what people are used to and what people have been planning for. So it's a little bit of a shock effect that's going on here.
Absolutely. Yeah, we're absolutely not used to it. So having to pay much more for mortgage and interest rates doesn't seem normal.
Right, right.
um, let's talk about that a little bit because you mentioned you expect the Fed actually not to raise rates anymore, but keep it higher for longer, right? And
Yep.
we just broke through $33 trillion in debt as well. So debt service rates is going to be $1 trillion roughly a year.
Yep.
rising, obviously, because we'll be issuing another at least $1.5 trillion in T-bills and corporate, no, not corporate bonds, sorry, coupons. Like there's T-bills short dated, and of course the longer ones, the Treasury bonds, over the next 3 months here, more or less, right?
Yep.
So where am I going with this? Like the interest payments, like at some point, it's going to get political, right? Do you think Jerome Powell will see some political pressure to actually lower rates as well? Do you think that's going to get louder out there?
I think the one thing I will say that I have to applaud the Fed, especially Powell, on is they have really, I mean, and they've tried their best to keep politics out of central banking, which is always a good thing. You never want politics in central banking. You want it to be an independent entity. So I think really what the Fed is doing, and this is why we're calling just for a very long pause, no rate hike this week, no rate hike, and no more rate hikes in this cycle is what we're calling for. Because the Fed is taking this meeting by meeting approach. I think we've seen a lot. We're starting to see core inflation numbers come down. Are there some bumps in the road, such as a recent spike in oil prices? Yes. Can things change? Absolutely. But I think rates are and even the ECB said their rates are sufficiently restrictive in their view. And I think the Fed is slowly pivoting to that. I think the Fed thinks that they're done raising rates, but they don't want to say it, because if they jump the gun and they get markets prepared for no more rate hikes, and then they'd have to raise rates again, it's going to be another shock. So they want to leave everything on the table, but I think they know that rates are definitely very restrictive right now. And I don't think it makes sense to just keep raising and raising when you don't, monetary policy lags, right? So you kind of have to wait a few months even to see, they raised rates in July. They've been raising rates all year. You kind of have to give it some time to see. The data lags. And unemployment is also something that they're watching. It started spiking a little bit last month. We're from 3.5 to 3.8%, but still historically low. And from an economic perspective, we're still well below, or we're still well ahead of the full employment threshold of 5% of unemployment. So I think the Fed is starting to pave the path for just a very long pause, keep rates sufficiently restrictive. That does not mean rates are going to come down. And that also doesn't mean mortgage rates or interest rates are going to come down. So just because the Fed funds rate is no longer rising, there's a lot of factors also driving rates that are impacting consumers, right, on the day-to-day basis, other than the Fed. But I think the Fed funds rate is going to stay at current levels all the way through early 2024, probably even into next summer. Then we can start talking about rate cuts. But if you go too far, you risk a recession. And if you cut too early, you risk inflation coming back. And the Fed really does not want to have any of those after what we've had over the last 2 to 3 years.
Definitely not. So far as like, it's almost bad to say it, but I think they've done a fairly decent job. Like I've said that in another view as well. Like they mentioned inflation was transitory. If I look at the inflation curve, looks like it, seems like it, based on, commodity prices as an example, for example. Like if I look at the lumber price, it looks like the inflation chart.
Right. I think the Fed has done a decent job after the fact, right? I think they moved too late. And I also think that they're kind of dealing with, they've been dealt a hand, but there's a lot of things impacting what's happening that's outside of that hand they've been dealt. So inflation has two, inflation 101. There's two aspects of inflation. There's demand side inflation, which the Fed has a strong grasp on. And then there's supply side inflation. A lot of this inflation has been from supply, right? From geopolitical tensions, disruptions in supply chains. We're coming out of the lockdown. You have the Russian and Ukraine conflict, which is which has obviously impacted many commodities, and including oil prices. And then you also have OPEC, who's committed to higher oil prices. They've made that clear. There's so many factors going on that are outside the Fed's control, and they're trying to compensate for that by making rates more restrictive, right? But it's almost like you need the supply picture to give a little bit. And once that gives, then the Fed, you'll really start to feel the effects of higher rates. And so I think right now, a lot of it was they're just playing the hand that they were dealt. They were definitely late. They lowered rates too quickly, and then they started raising rates too late. I think that's the biggest mistake they made, but that's happened many times, and it's very easy to say that in retrospect. But right now, I think they're doing everything right based on the hand that they've been dealt.
Absolutely. No, I think so. I was like, I'm not praising Jerome Powell here as well, but it seems fitting, like what they've done and what they've said. Like they haven't really deviated. So for me, as it's like I'm not a big time economist here. I'm just a commentator and a podcaster. It seemed coherent. Like there wasn't a lot of deviation, not a lot of flip flopping. So
Yeah, they
no,
definitely stick with a
that's
narrative, and I think they're going to stick with that narrative going
yeah,
forward.
absolutely. Trying to combine two topics here. One is the higher inflation topic, but also you mentioned higher oil prices. I wrote that down as a separate sort of discussion topic because we're nearing $100 US a barrel again, right? For crude and Brent. What do you think the impact will be, and maybe how does the higher oil price fit in the overall picture here?
Yeah, I think so. First, I mean, we've been in our newsletter for subscribers, we've been bullish of oil prices for the entirety of the summer. And I think the premise there, what's happening in oil markets is you're undersupplied, which is no secret. There's OPEC is cutting production, voluntary cuts, as Russia's production's lower. There's a price cap on Russian crude oil in Europe. There's, US levels of production can't keep up with demand. And then there's also the demand situation where demand has been surprising to the upside everywhere in China, in the US, globally. It's just been, I mean, like we were saying, many people were expecting a recession. We didn't have the recession. So oil prices are back up. Where does that play into everything? I think you're going to see more pressure on the consumer. And I think that, a lot of the things that a lot of the categories of inflation. So CPI is broken down into many, many categories, but a lot of the categories that are impacting people on a day-to-day basis, like fuel prices or rent or food, these kind of things are still well above 3% inflation. And this is going to add more pressure to that. Does that mean that I think the consumer is about to collapse or that we're about to crash? Probably not. And I think that oil prices are due for some sort of a pullback after such a hot run this summer. But I think higher oil prices are just the new normal. And I think the days of seeing $30, $40 crude oil, they're not over. They'll be back eventually. But for the next couple of years, I think we're going to see elevated oil and gas prices.
Interesting. Yeah, it's like I need to read a quote to you. It's like from the Wall Street Journal. Was it just an article that came out earlier today? Is OPEC conduct is nothing different from what a central bank or a group of central bankers is doing, and that's from the minister for oil from Saudi Arabia, just putting OPEC next to central banks. I thought that was a really interesting comment because now they're using OPEC also. How would you tool? It's like as a tool to influence politics to a degree as
Right. I
well.
mean, they I guess they're right in that they are the central bank of oil, right? And they have been that. And what's interesting is if you go back to 2014, 2015, everyone was saying OPEC is, the strength of OPEC is no longer there. They're not united. A lot of the times they'd implement production cuts and then they wouldn't really hold. But the OPEC has been laser focused on their policy that there's no deviation. They're even doing voluntary cuts beyond what they agreed to. And this has been going on for a couple of years now. So I think, that article has some truth. OPEC realized that they are the central bank of oil in a way. And even though the US is now one of the largest producers in the world, OPEC oil is just as important, if not more important than ever. And they're going to continue to use that to their advantage. And I mean, I think that article is 100% correct.
Absolutely, yeah. $100 oil is quite political because it influences a lot of decisions worldwide on in the financial markets.
It does.
Fed fund rates is one of them, right? Um,
Yep.
Adam, I can't let you go without doing a little bit of forecasting as well. Like we have 3 more months to go, pretty much until the end of the year, October, November, December. What are you sort of predicting? Like, what's your prediction for the next 3 months? S&P, commodity prices, oil to a degree as well.
Yeah, so we've every week we publish our calls for subscribers, and we've been pretty bullish of the S&P, as I mentioned, equities all year. And we think as markets transition, there's still a case of at least 1 to 2 more rate hikes being priced into futures, as we believe it will transition to just a long pause, as I previously explained. I think this is going to actually be somewhat of a bullish shift for equities into year end. And I also think earnings, and we have another quarter of earnings coming up soon. They continue to surprise to the upside. So expectations have definitely come down. I think equities are going to continue to be resilient. We will certainly see volatility. A 5% drawdown in equities is not out of the question ever at any point. It can start at any point. But I think ultimately we're going to keep drifting higher. Commodities, I think that the shift in the Fed policy into a longer pause means a little bit of weakness coming in the dollar, also means some strength coming in the commodity world. Aside from natural gas, which we cover, natural gas is a beast of its own. Won't get into that now, but we've been trading. Natural gas has been a great trade to both directions all year. And then bond markets as a whole, right now, I think the 10-year note yield is going to hit 4.5%. And then not necessarily because higher for longer, not higher rates, but just a longer pause for longer is still bullish for treasury yields and bearish for bonds. So it's interesting. I think we could have some divergence here between bonds and gold. I mean, we've been seeing it. There's been a huge divergence. I think that can continue where gold is now the safe haven trade and bonds are viewed as like the hawkish. You're betting on a hawkish Fed or the higher for longer is the bond trade. Even if that doesn't mean more rate hikes, even a longer pause has been now bearish for bonds. So that's also something that's kind of fueling our long gold narrative. We think it's going higher as well, just as you said. But a lot of different moving parts. The general theme, Fed is pausing for longer and markets have just been more resilient than most people are expecting. But there's definitely weakness in many parts of the macroeconomic picture that we're not afraid to point out, as you've seen on our Twitter.
Absolutely. Yeah, no, fantastic. And it was I was going to end with that note as well. Ask you, like, what kind of tweet gets the most traction?
Well, I think there is definitely macro tweets have just become very popular. So back when finance Twitter first started, we've been doing finance Twitter for almost 10 years now. It was extremely technical. I mean, if I were to tweet the kind of technical stuff we would tweet back then, or sorry, I should say post on X, it's X now. It wouldn't get any views. Now, I think macro has become much more prevalent. People are very interested in macro, and I think it's rightfully so. Macro is super interesting. So anything relating to the Fed, US debt, interest rates, housing, that's the kind of stuff we've been covering a lot more of. But we do also in our newsletter and our subscription have that much more technical view where we're trading, where we're giving very, very in-depth analysis. So I think, it's a little bit of a balance of both, but it's a great time to be on X Twitter. So if you're not Finance X, I call it now, not FinTwit. But it's a great time to be on there. So if you're not on it, definitely hop
Absolutely. And give Adam a follow at Kobeissi letter as well. Fantastic, fantastic content you put out there pretty much on an hourly basis. That's
Appreciate it.
It's insane how you do it. Really, really worth a follow. And of course, Adam, really appreciate your time appreciate you coming on here.
Yeah, thanks for having me on, Kai. Super, super excited for this to air and just to, see how the channel continues to grow. You guys are doing great work.
Fantastic. No, I appreciate it. We'll need to get you back on maybe at the end of the year, so do a bit of a recap and try to do some forecasting, which is always difficult to do. So appreciate that. Fantastic. Everybody else, thank you so much for tuning in. We hope you enjoyed this conversation here with Adam. If you did, subscribe, please. There's a subscribe button. It says subscribe on it. It's a square box. Because I know 80 to 85% of you watching are not subscribed to the channel. It helps us tremendously grow the channel and also bring guests like Adam on more frequently and bring guests of other great caliber on as well. We really appreciate it. Engage with us, hit that like button, and leave a comment. What do you think is going to happen? Did Jerome Powell do the right thing? Should we end the Fed? I don't know. I'm just throwing some questions out there, but leave that in a comment. What are you thinking is going to happen in the next 3 months as well in the markets? Really looking forward to hearing from you, and thank you so much for tuning in. We'll be back with lots more.